Have you ever looked at your statement and seen the word index fund and just kind of moved on? I mean, you figure you might look it up later, or maybe you just trusted that there was somebody at your advisor's firm, or maybe even your advisor. You were just hoping that they understood what on earth it was and what's going on. Well, today's the day that we fix that because this one is actually a really simple definition. And once you get it, it'll make a lot of other things click for you as well. If we haven't met yet, I'm Darren Vilardo. I'm a financial advisor. In fact, I'm the founder of Tekton Wealth Advisors. And we work with folks who are getting close to retirement or who are already there. And we help them build a plan that they can actually feel good about. We like to say that we love, serve, and care for our clients so they can live their best life in retirement. Now, this series is really all about financial jargon and helping to take some of the words that your advisor might use and, quite frankly, just translating them into plain English. No textbook, no sales pitch, just plain English. Today's word, index fund. Now, here's the very simple version. An index fund is a basket of investments that's built to copy a piece of the market, not beat it, copy it. Think of something like the S&P 500, for example. That's simply a list of the 500 biggest companies in the US. An index fund just tracks it. It just owns all of them. If a company is on the list, it's in the fund. Simple as that. Nobody's picking winners. Nobody's trying to time the market. The whole strategy is simply to own the market while keeping costs low. We just leave it alone. Now, here's how a financial professional might say it, and I want you to just listen because this is real. A passively managed index fund seeks to replicate the performance of a benchmark index by holding a proportionally weighted portfolio of the constituent securities, thereby minimizing tracking error and management expense. Yeah, well, that's a lot of words to say that it just copies the list. But let me be clear about what an index fund is and what it's not. First of all, an index fund is completely passive. There's no manager sitting in an office making decisions about what to buy and what to sell, what to hold. It just follows the index. That's the whole job. An index fund is usually much lower cost because there's no team of analysts to pay. You're not paying for someone's expertise. You're just paying for the mechanics of holding the fund and mirroring all those holdings that are on the list. By the way, that fee difference, it really adds up over time. I'll give you an example, and this is illustrative only, by the way. We want to be vaguely correct as opposed to precisely incorrect. But imagine two funds, and let's say you have $500,000 in each. One charges 1% a year. That's $5,000 a year in expenses. The other charges essentially 5/100ths of a percent, 0.05%. That's a huge difference, right? It's 20 times less literally every single year. And over 20 years, that gap in fees can make a huge difference, even if both funds perform the same. Now, an index fund, as I said, it's not stock picking. It's not trying to find the next great company. The strategy is to own all of them. And by the way, it's not a guarantee of any kind. I want to be very clear about that. Just because you're paying less in expenses, the reality is that for an index fund, when the market goes up, your fund goes up. But guess what? When the market goes down, the fund goes down too. It's tracking the market. There's no manager there trying to protect you on the way down. That's the whole deal. And for a lot of people, particularly retirees, knowing exactly what you own, the simplicity and transparency, and why you own something, well, we believe that's worth a lot. Now, in the last episode, we talked about mutual funds, and here's the big difference. A mutual fund is typically actively managed. There's a manager attached to that mutual fund whose job is to try to beat the market. An index fund doesn't try to beat anything, it just matches whatever the index does. Now, active managers are smart people, but study after study has shown that most of them don't beat the simple stock market index over long periods of time. Now, I really believe that understanding this distinction is one of the most important things you can do as someone who is planning for retirement. So, index fund, a basket of investments built to copy the market or a particular segment of the market, but not trying to beat it. Low cost, transparent, no surprises about what you own. And yeah, it goes up and down with the market. That's the honest truth. But for a lot of people, that clarity is exactly what they really need. So, if any of this got you thinking about your own situation, I'd love to have that conversation. When it makes sense to take a closer look at what you own, does it work for you? What's the purpose? Do you really understand it? And our promise, as always, is we will serve you and not sell you because, as I said, we love, serve, and care for our clients so they can live their best life in retirement. And I would add that if you found this video a little bit useful or valuable, I want to encourage you to hit that like and subscribe button so that others who have similar questions or concern can find this channel. Thank you so much. God bless.